Hey everyone, it's Matt Williams with JTM Williams Capital Management. This is the review for the week ending July 17th, 2026. I'm recording this Saturday, July 18th, 2026. I hope everyone is having a great weekend thus far. As a reminder, the ETFs, indexes, and securities mentioned in this video are for illustrative purposes only and do not constitute a recommendation to buy or sell. Please refer to the disclosures at the beginning and ending of this video. Please make sure also to like and subscribe to the channel if you're getting anything from this. Let's get started. Okay, so I'm going to share my screen. We'll just start off with how major indexes did here this week. Um, so as we can see, the S&P was down about 1.5% here this week. The Nasdaq down a little bit more. Emerging market stocks bearing the brunt, I think, of the selling here this week. We're going to get into the rotation that's currently transpiring, especially in the AI slash momentum trade, however you want to refer to it. Big action was crude oil, which was up a little over 15% here this week, as it seems that hostilities over in the Middle East are starting to fire back up again. We'll get into, what that means again for interest rates, the market, sectors, so on and so forth. As we can see here for the week, how that end up impacting sectors. Energy ended up leading up 4.72%. The semis, again, which we'll get into, were down over 10% here this week. The semis are right now in quite a bit of a drawdown, and as we have discussed at this point, they're a very major part of the S&P 500. They're right now, I think, approximately somewhere in excess of 20%. If they were their own sector right now, they'd be the largest sector, even if you took them out of technology. Um, Moving forward, so we'll see most of the action here this week in the market took place here yesterday. On Friday, it was options expiration yesterday. You normally get some heightened volatility as a result of that. What I want to go over, again here is just what's happening with the AI slash momentum trade. That's where most of the fireworks have been, where most of the drawdown has been here in the last month. And again, just to go over again, the momentum stocks, those are ETFs and strategies that there are different ways of allocating those, structuring those ETFs, but it's effectively there you're buying the leaders over a certain look back period, hence momentum. It's, in some cases, again, like I'm a trend follower, love momentum strategies. I don't necessarily buy the ETFs. I like to get a little more granular with that. But as we can see here, we'll first off show, the drawdown that the semiconductors are in. Wait a second. So as we can see here, the semis are in a drawdown right now of about 24% here since the peak in mid-June. Now, again, what we're going to get into is because we've at least had some rotation, you're not really seeing a whole lot of movement in the headline in the S&P. It's more right now, if you are seeing the major index, it's actually the Nasdaq. Um, the equal weight S&P 500 and the value indexes actually made new highs here this past week. And again, I think as I mentioned in my last video, if you're having money coming out of the semiconductors, coming out of the AI trade, the logical places for it to go are back into the Mag 7, healthcare, financials, some of the big, liquid parts of the market that can absorb that type of money leaving semiconductors, going into the other parts of the market for it. Um, so here again, let's look at the momentum index. Again, it's in a roughly pretty similar drawdown to the semiconductors. At this point right now, something like half of the momentum index is semiconductors. It's mostly semiconductor slash AI stocks. There's some industrials in there. The industrials at this point are, Caterpillar, GE, Vernova. Again, most of the industrials that are also caught up in the AI data center build out. You could also uh, throw in there the down move we've had in South Korea. That stock index is made up of SK Hynix, Samsung, two of the big DRAM companies. There's an ETF for that. DRAM, again, you're seeing it's in another fairly major drawdown, alongside the semiconductor stocks. Uh, South Korea. Let's take a look at you could look at the EM trade or EMXC, which is the emerging markets ex China. At this point, again, it's all one trade. Taiwan, South Korea, memory stocks, chip stocks, semiconductors, call it momentum. Those have been what has been leadership here so far, at least let's say the first 6 months of 2026, especially coming off the March low. Uh, Going back to the semiconductors, they absolutely just rocketed off this low, doubling in value, which is a big reason why, the technology stocks led the S&P by such a significant extent. And then even going a little bit more broad-based to the NASDAQ 100, the QQQ, same thing, just absolutely just rocketed off those March lows. Now, again, it's in a little bit of a wedge here. What I'm concerned about is breaking here out of this wedge. Um, Most would assume when you get into these type of what's called continuation patterns that you're going to resolve the trend, or excuse me, it's going to resolve in the direction of the underlying trend. Well, the underlying trend here so far is up. If this ends up resolving to the downside, I'm assuming we're at least going to have some short-term problems. One thing that I did like seeing, at least here intraday yesterday, is as I've mentioned, while money has left the semiconductor stocks, the momentum stocks, that's hit technology, and to a lesser extent, the QQQ, money has been rotating. Now, let me show where it's been rotating at. Um, if you see here, so blue right here is the momentum stocks, green's the NASDAQ 100, um, purple, the S&P equal weight, right here's the S&P, and orange is the S&P 500 value. So even though, we've had some money leaving some of these strategies and some of the hotter parts of the market, um, it's rotating amongst the S&P. That's why the headline market really hasn't moved a whole lot. Obviously we had a less than desirable day yesterday, but again, equal weight, value, S&P, all have made, new highs here in the last week or so. Obviously, we'll have to see what ends up happening with the chip stocks. They're not just going to go up to infinity. You are going to end up having a rotation. Hence, again, as I mentioned, that as long as, or again, seeing that the S&P equal weight is making new highs is still encouraging. That means that the money's not leaving the market. It's just moving around in the market. And what I can show you here is, again, even as the S&P 500 is barely off of its highs, we've got more stocks above their 20-day, more stocks above their 50-day moving average, more stocks here this week are going up above their 200-day moving average. More a percentage of more stocks in the S&P are above their bullish point and figure charts. Just what this means is that you've got more stocks in the S&P 500 that are in short-term uptrends, intermediate-term uptrends, and long-term uptrends. So again, that's healthy. So while even though you've got one part of the market that has been by far the best performer here year to date, money is leaving that sub-industry sector and it's going to other parts of the market, which again, as long as that continues, that's good. Rotation is perfectly normal and healthy for bull markets. Let's get into just how big this momentum drawdown's been and let's just say what we can hopefully, or excuse me, what can we look for to see when does this stop? When potentially can money start rotating back into those growth areas? Um, what I want to show here, this is the iShares MSCI momentum factor relative to the S&P 500. And we're going back effectively to inception here just a little bit more than 13 years ago. And what this is, again, this is not an absolute chart. This is a relative chart. So is it what's momentum stocks doing relative to the S&P 500? Now down below, this is a 21-day rate of change. And as we can see here, right now, you are in the middle of you've had some historic outperformance in the short term on momentum stocks over the S&P 500, and now you're in a fairly significant drawdown. So by this, you're seeing here in the last 21 trading days, you're in one of the three worst relative drawdowns going back to the inception of this index. Now, normally the good news is when you start having this much of a drawdown, you do tend to have a snapback relatively soon. So what would we be looking for to see when does this end up having a snapback? So yesterday, what I was looking for was As you can see, the semiconductors opened down. Let me take this off here briefly. The semiconductors opened down sharp, ended up reversing to the upside there in the morning at midday. All the while, you could tell that there was rotation going on. You had another panic at the open, selling semiconductors, selling tech stocks, buying financials, buying healthcare, um, buying small caps, buying staples, buying effectively value and defensive dividend-paying stocks. What you want to see, or at least what I would like to see to show when this is stopped, is I want to see a reversal, kind of like we were seeing here yesterday. I want to see that hold though, where we effectively broke this neckline here in the semiconductors. What I'd like to see is you probably have a lot of people that got blown out here where they had their stops um, set that took them out of their trades and they effectively puked the open. You had buyers come in, and even though like what you could look at this and say, okay, this is a potentially bearish head and shoulders. This could be again a failed breakdown, which would potentially catch all these shorts off guard and just rip it back up to the upside, very similarly to what happened here, where this was looking like a big head and shoulders. You broke right here, this call it just 315 level that I look at support, got down, and all of a sudden just bam, ripped it right back in people's faces. Um, in a lot of cases, some of the most powerful patterns are failed breakdowns and failed breakouts. There's a saying that come failed moves, come fast moves in the opposite direction. That's potentially what we would look for. Now, again, what's the inverse of a hammer? Meaning that you end up having a big, you have a big down open that ends up reversing itself throughout the day. Um, Let me show you the DRAM stocks. Um, those did finish up. So again, they were down big. They were up a lot bigger at one point in the day. They still finished up, okay, which is still that's on balance. I'd still like to say that's constructive. Um, let's go. Let's take a look at something like your dividend index, where you had a buying panic, and this right here, this is the S&P 500 high dividend ETF. This is REITs, utilities, energy stocks, financials. There's very, very little tech in this index. There's virtually no semiconductors, no tech. I'd liken it. It's also pretty similar to this one, HDV. It's the iShares core high dividend. This is a lot of healthcare, energy, financials, staples, etc. Again, very, very little technology in these indexes. The opposite of a hammer candle is a shooting star. And, so as the day was going on, you had a buying panic at the open and a quick reversal. So, for those that don't know what I'm talking about when I'm discussing like candlesticks, these are terms, and when you're looking at candlestick charts, where it's a visualization of the buying and selling of, a security, during the day. So you can see you've got the open, the high, the low, the close. So again, you can look at this and see the range it traded in, where was the high, where was the low, where did it open, where did it close. Um, it's something a lot of technicians and chartists end up looking at. But in a lot of cases, what they can signal, whether it's a hammer candle or shooting star, it's a reversal. So right here, what I would say is when we go in and look at financials, look at healthcare, look at your defensive indexes. A lot of them yesterday showed some buying panic at the open and ended up reversing down. Now, the flip side of that, again, would have been the growth trade, where, again, you're looking at the semiconductors, you're looking at South Korea. Again, South Korea at one point, this almost looked like we had a outside reversal that was building. What I'd like to see sometime here this upcoming week is a continuation of that type of a reversal to show that this change in momentum has potentially ended. So again, even at one point, momentum index was down big at the open, rallied throughout the day, was up at one point. Just unfortunately, we had some selling there in the last hour, which negated some of these patterns. But again, that's what I'm looking for. If again this momentum drawdown is going to end, what you just want to see is you want to see those leaders that have been beaten up here in the last month. You want to see them stop going down. You want to see them reverse, and you want to see this rotations, but going into value, dividend payers, defensive parts of the market. You want to see that reverse very similarly to what we did here yesterday, where they put shooting stars in, and you want to see money come out of that sector. Now, again, um, we'll look real quick. I think I mentioned this will be the last thing we go over here today. Um, Crude oil. We discussed one of the big issues I was noticing here in the last video at the end of June, beginning of July, is you know, because of at the time what appeared to be some cessation in hostilities over in the Middle East between the U.S. and Iran. After the signing of the Memorandum of Understanding, we did have a pretty significant drawdown in crude oil. Having said that, as I showed in the last video, there was an anomaly building up where even though WTI, Texas Intermediate Crude, and Brent Crude had dropped very significantly here since the middle of May, uh, gasoline, heating oil, diesel fuel, the things that we actually consume, we're not showing the drawdowns that oil itself was showing. And again, I'm not an economist, I'm not an energy analyst. It's something I definitely pay attention to as somebody who owns commodities and trades commodities for clients. There seemed to be just a very large disconnect for, okay, why is oil dropping like this? The gasoline's not going down. Why is diesel not going down? Why is heating oil not going down? So if you can see here, as far as spot gasoline, again, um, it's not too far off from its high. If we want to look again at, let's say, that ratio that I showed here a few weeks ago, we'll look at gasoline to Brent. Um, Not quite at the multi-decade highs that I showed, but it is still extraordinarily elevated. Again, a lot of reasons for that. Again, I am going to have a friend on here this week who's an economist. One thing I do want to ask him, obviously, is that how does this all play out as far as what we see when we see headline consumer price index numbers? Because again, I don't believe crude oil is in the CPI, but gasoline and diesel are because we consume those. When you go to the gas station, you're not filling up your SUV with oil. You're filling it up with gasoline, or you're filling up your truck with diesel fuel. So again, that's what we end up consuming. One other quick thing, real quick, I'd say here in the commodity market, has been catching my eye. This is DBA. What DBA is, this is an ETF that holds agricultural commodities: corn, wheat, soybeans, cattle, sugar, coffee, cocoa. Another thing that I noticed was that um, agricultural commodities, very similarly to gasoline, diesel, again, let's just say that the commodities that were not just WTI, crude oil, or Brent oil, um, reversed and started heading higher before oil bottomed. And there's various reasons for that, but again, this makes up. I mean, obviously, we all eat. We all consume wheat, corn, soybeans, etc. Everyone's got to eat. Um, this is something else that's going to greatly impact what ends up happening with the consumer price index, and also just the broad commodity indexes in general. Um, I believe right now, if you look at something here like a PDBC, which is an ETF I like to trade, uh, something close to, I believe, about 25 to 30% of it, some other indexes a little bit higher, are just the agricultural commodities. So again, something to keep an eye on is what's going to happen with some of the softs. Again, corn, wheat, soybeans, orange juice, coffee, cocoa, so on and so forth. Let me just finish up with bond yields real quick. Um, Here so far this month, since the last time we spoke, we did have a pretty big spike in interest rates. They came down a little bit here after the CPI and PPI numbers here this week. We'll keep an eye on those. Let me stop sharing here. Yeah, so that's the recap here for the weekend in July 17th. Please be sure to like and subscribe this video. If anybody has any questions, please feel free to reach out to me at my email is matt@jtmwilliams.com. Happy to speak to anyone who has any questions about anything we went over. Or just reach me at my office number is 703-782-3110. Looking forward to hearing from you. I hope everybody has a great weekend and a good week ahead.